You can't cheat life insurance, you can't cheat health insurance, and you can't cheat long-term care. It costs money. Welcome to the Retire on Time Q&A podcast. I'm Michael Decker here with David Franson from Kedrick Wealth. As always, text your questions to 913-363-1234 and we will feature them on the show. Just remember, this is a show, it's not financial advice. David, what do we got today?
Hey, Mike, what's the best way to plan for rising healthcare costs?
Rising healthcare costs is one of those things you can't control. And we've talked about this before. There's plenty of things in life you can't control. And if you focus on those things, you're probably in a difficult emotional state, right? But there's a lot of things that you can control. And so when we understand that, let's first just talk about what we can control. We can control what's in our portfolio. We can control the insurance products that we buy. We can control our health. We can control our projections. And so when you start to look at what you can control, just assume healthcare costs are going to increase. Just assume that inflation is going to be an issue. Just assume markets are going to go up and down. But overall, if you have a long enough period of time, like 15 to 20 years, overall they should be relatively up. Are you with me so far?
Okay, yeah. What's relatively up, all the markets?
The stock market,
Yeah.
to put it simply,
Yes.
in that situation. But real estate markets typically trend upwards as
Okay,
well.
yep.
The bond market is like the little engine that could. It just keeps chugging along.
Okay.
Right? So, but generally speaking, any market, which is a place to make money, should increase. Some may increase better to offset inflation, and others, maybe they just barely keep up with inflation, kind of like the bond market.
Okay.
So with that as the backdrop, you've got a couple of different options for healthcare. And this might sound strange. I am licensed to sell long-term care insurance. In 10 years of working in the retirement space, I've never actually sold a policy. So either I'm really, really bad at selling it, or I really understand the economics of it. And you take your pick which one it's going to be. But here's my whole thing on this, okay? So the expression I say is, if you need it, you probably can't afford it. And if you can't afford it, you probably don't need it. In that, if you buy an asset-based long-term care policy, which is kind of like what they are today, what happens is the dollars that you put in will be multiplied and then paid out for a certain period of time.
Okay.
So it's not like you're going to put in X amount of money and everything's covered. It's not how it works. You might put like some sort of inflationary rider on it, which costs money, but that would increase your benefit over a certain period of time by like 3% typically. But it doesn't just solve everything, okay? You have to think about it from an insurance standpoint. You're transferring a risk to an insurance company for a potential payout, but the financial odds are in the insurance company's favor.
Which is usually the case, right? And should we have peace with that?
Do you want insurance companies to stay around?
Yeah.
Or do you want to be the sucker that bought an insurance policy, they went broke and you got nothing? I mean, there are state trusts and backs and things like that. But
Okay.
the point being is they have to stay solvent. So the odds have to be in their favor. So the way I like to look at long-term care is, if you want a long-term care policy, and let's say you buy it, you're really transferring long-term care risk, dollar for dollar, for the next 10, maybe 15 years. Because if you needed long-term care within that time period, that might have been a better option financially speaking. You would have gotten more dollar for dollar. But if there's any red flags on your healthcare exams, they're not going to give you the policy.
They're going to see you as a risk and like,
It's unnecessary risk for the insurance company. And so if you look at dollar for dollar, how much would you put into a long-term care policy versus the dollar for dollar, just put it in the market, let's say a 50-50 split stocks and bonds, and you just grow it for a 10, 15, 20 plus year period of time, you have to ask yourself, which version is going to get you more money? And what we're looking at is the internal rate of return here.
Yeah, define that.
So the money that moves in or out, and then the annual actual growth of those funds.
Okay.
If you're healthy, it might be better to put it in something like the market. Now, the market doesn't promise returns. Those aren't guaranteed returns. putting a bunch of things in like a CD or a treasury ladder for your healthcare, that might not keep up with inflation. Like there is an element you're taking with risk in self-insuring.
Mm.
But I just want to highlight like the long-term care bit of it, though it has some rigidity, it's probably not going to get you rich. And if you never used it, the death benefit's so minimal anyway. It's kind of it's an insurance product. And so when I look at this, I think, okay, if someone genuinely is concerned about health, they have poor family history, and they're like, I'm healthy today, but that could change any moment, and I'm concerned about the beginning of retirement and my spouse, the surviving spouse, and that my potential illness, based on my family history, might bankrupt the spouse.
Okay.
You might be willing to pay the premiums, knowing the odds could be against you, to transfer that risk to an insurance company.
All right. That's a good explanation.
Do you see a very clear bit here? This isn't,
Yeah.
oh, everyone needs it because what if?
Yeah.
Everyone's different. And there's different risks you're willing to take on, and there's different risks you want to transfer to an insurance company. And you can only transfer risk to an insurance company. That's the definition of insurance. You're not transferring risks to the stock market. The stock market is risk.
Yeah.
You're not transferring risk to your real estate portfolio. Your real estate portfolio has its own risks. So just so we're clearly defined there. Now there are other options here to help hedge against it. One is index universal life insurance is becoming a more popular way to hedge against it. And the idea here is if you're in need of long-term care insurance,
Yeah.
you're probably on your way out.
What people do, when do they typically start? When does someone get an LTC policy?
Years before they need it. I mean, you're not going to go in and say, "Hey, I need this now. I'm going into hospice."
So that's
or
when
something.
they get
So
denied.
You
Right?
get it early,
Yeah.
right? You have to be healthy. You have to be young enough.
So 60s?
50s,
Oh, okay.
60, 65.
Okay.
I mean, I know they approve other people. It's just the older you get, the more expensive life insurance is going to be. And this is life insurance.
Yeah.
And so with indexed universal life insurance, the first 10 years, for what it's worth, ain't going to grow that much. The fees are typically front loaded. And then after 10 years, then it starts to compound or has the ability to grow the cash value a little bit better.
Okay.
But if you needed long-term care, they're like, hey, you're kind of dying. We have a death benefit. We'll let you tap into the death benefit early. So what you've done is you've said, I want to transfer some risk here. There's the death benefit, which is a little bit higher than maybe the traditional long-term care based on how you structure the policy. Maybe you got a little bit more wiggle room, but you're using the cash value to try and kind of be a bond fund alternative in that you're just looking for over a 10 to 15, maybe 20-year period of time, a slightly better internal rate of return than the bond funds what they would offer.
Okay.
So you're swapping one thing for another. It's not a guarantee. There's no promise on any of this here on the cash growth, right? You can't promise growth. But that's a way you can hedge against it. And if you didn't use it, you still have the death benefit, which the asset-based long-term care insurance didn't have. They're priced differently, so you're going to put more money into an IUL than you would asset-based long-term care insurance. And so it's all just a simple calculation of what do you want to transfer as far as risk to an insurance company, what flexibilities do you want in the future, do you want assets in the future, do you not want assets in the future? It's just a conversation because none of these are perfect. For everything you get, you're giving up something, and that's okay. That's how all finance works. So that's kind of the middle hybrid ground. Now, there are annuities out there that pay a lifetime income, and if you were to qualify for long-term care, and by the way, to qualify, you just can't do 2 of the 5 or so daily activities.
Oh, okay.
So you can't dress yourself, you can't feed yourself, for example.
Then you qualify.
Yeah.
Okay.
Get the doctor's note, then you're pretty much good to go.
Okay.
But where I was going with that is with annuities, people say, well, whenever I need it, the income's just going to double. What a great deal that is. And that is a great deal. I mean, if you buy an annuity, 2 years later, you turn on this long-term care rider, and there's usually like a little bit of a break there. You have to like have it on for 1 or 2 years. And then you get 5 years and you miraculously recover from long-term care insurance. Or not long-term care insurance.
You recover from the insurance. Yeah.
You healed. You healed. then the income goes down and it's still lifetime income. So
Okay.
that's kind of a good deal.
So you recover from whatever injury you had, or you were in rehab, or whatever it was, and you're out, you're back home,
Yeah.
and
You know,
then
you typed into ChatGPT and created your own vaccine and you just cured
oh,
cancer. I don't,
okay,
did you hear
yeah,
about that?
no,
Allegedly some guy, his dog was dying. So he uses ChatGPT to make a homemade vaccine,
oh,
sticks it in the dog. And as the news story said,
uh-huh,
the dog recovered from cancer or something. And he uses ChatGPT to make a vaccine, a
wow,
homemade vaccine.
okay,
I'm assuming he's like a chemist or something at the very least. This is not your typical pursuit, but
yeah,
you know, maybe you end up in long-term care for a little bit or in hospice. There's a medical breakthrough or a medication just takes off and you recover.
okay,
Things happen.
yeah,
So you still have that lifetime income, which is kind of nice.
oh,
But the part that people miss, and this really gets my goat. You ready for it?
mm-hmm,
There are lines in these insurance contracts. They're not sketchy. It's just, again, insurance. Now it's priced in. That your lifetime income is associated with a cash value. And that cash value is going down every year you spend it
uh-huh,
because you're getting lifetime income. So the cash value will probably hit zero, maybe in year 10, 12, 14 or so, right? Within the first 10 to 15 years, it'll probably zero out.
okay,
Once it zeroes out, that income doubler is gone.
mm,
You can't get it anymore
huh,
because they doubled your income saying, well, you're going to die or you might die. So we'll give you your money back based on the cash value just a little bit faster.
okay,
Because if you died and there was cash value left anyway, they'd have to pay it out anyway.
oh, right,
So, and that's not true with all products. This is a generalization. But do you see how in asset-based long-term care, the traditional side of things, you put a little bit amount of money in for a large multiplier, but long-term, it's kind of worthless.
mm,
It's not really worthless. It's just, it may not have kept up with inflation. It may not be as much as you need. It's for a pocket of time. The index universal life insurance is going to require you to put a lot more in there to get that death benefit, but you've got a nicer benefit later on for income or flexibility. There's a death benefit and so on. Then you've got your lifetime income, but that only works for the first 10 to 15 years, kind of like the traditional anyway.
mm,
So the point is, and I can't tell you how many times I've gotten this question. You can't cheat life insurance, you can't cheat health insurance, and you can't cheat long-term care. It costs money. And so when you put the options out there, you're picking the path you're most comfortable with. And some of them, which is the last path that we're talking about today, just putting your money into an investment that you feel comfortable with that should grow and help offset inflation for the rising cost of healthcare so that in your 80s or 90s, if you need it, the money hopefully was able to compound in such a fashion that it was able to pay for it in the amount that you needed, in the way that you needed, and it wasn't a taxable situation that erupted something.
is that what we call self-insuring?
That's the self-insure. You're just going to pay out of pocket, which isn't bad.
Yeah,
You're paying out of pocket when you think about it in each situation
yeah,
because you're paying money for something.
right,
Either you're paying an insurance company and you're transferring the risk typically for a certain period of time. The benefit still might be their life for the lifetime, but it's maybe not as financially prudent.
mm,
Or you just put it in the market and say, yeah, I'll pay for it later.
yeah. I'll put this in, compounding does its thing, and then it'll be there if I need it.
We create these stories in our mind of saying, I don't want to deal with it. So you're the professional. Tell me how I get out of this risk.
Mm,
That's like saying, hey, I want to experience life with no problems, with no risks, with no heartache. It ain't going to happen.
no,
And anyone that suggests otherwise is selling you something pretty hard
yeah,
because it's just not going to happen. And anytime you hedge a risk, whether it's inflation risk, market risk, long-term care insurance,
mm,
right, or long-term care risk, healthcare risk,
yeah,
medical risk, take your pick. Anytime you hedge a risk, you're increasing your risk somewhere else.
yeah,
That's the puzzle. That's why retirement planning, in my opinion, should be plan first, strategy second, portfolio third.
Uh,
That's when you then talk about, do you really need these products? Do you really need these investments in this form? What's the time associated with all of it, and so on?
and we didn't talk about Medicare. How does Medicare feel like find its way into all this? Like everybody gets it at 65.
Yeah, but it's not long-term care insurance. It's not going to cover your long-term care, or it's not going to cover all of your health care needs. Medicare is great. I mean, when you look at the cost of health care before Medicare and after Medicare,
Uh-huh.
it's like, sign me up. That's a good deal.
Right.
That's a good deal for the 65 plus,
Yeah.
but it's not going to cover everything. And so you need to understand the differences between traditional Medicare, the Medigap plans,
Mm-hmm.
and then the Advantage plans. And just for what it's worth, anyone that says everyone should do one or the other
Yeah.
is hallucinating. They each have their own path. They each have their benefits and detriments.
Sure.
And when someone says, "Oh, well, stop it,"
Yeah,
right?
a little throwback there. Like
Yeah,
that. Callback.
just stop it.
Yeah.
It's like, well, hold on.
Yeah.
We're all living different lives here. We all have different amounts of health. We all have different expectations. I mean, in point of fact, some people see the doctor often and religiously,
Yeah.
not just for their annual checkups. Like, they're seeing the doctor often.
Mm-hmm.
Other people won't see a doctor more than 1 in 5 years.
Yeah.
So we all should pay for the same thing. You just
Yeah.
Context is king with healthcare. I think it's going to evolve rapidly
Mm.
over the next couple of years.
Mm-hmm.
So
Stay tuned for that.
yeah, pay close attention to who you vote for and what they say they're going to try and do,
Yeah.
because that's going to shape our healthcare in the future.
Do HSAs have a role in this too? I'm bringing in more for you.
Yeah, this is great. So HSAs, they can pay for healthcare costs
Yeah.
and so on. So if you have an HSA, don't spend it at the beginning of your plan. Let that be a great place to grow tax-free and pay out tax-free for your healthcare needs. Just
Yeah.
grow it, grow it, grow it. Maybe that's the riskier side of your portfolio because you don't plan to use it for 10, 15 years.
And side note, once you're on Medicare, you can no longer contribute to an HSA.
Correct.
So you're sort of stopped. Hopefully you've funded it enough, up to your 65th.
Oh yeah,
birthday or-
you shove funds into your Roth and into your HSA as best you can.
Ah, yes.
And you can do interesting things. Like if you're like right now, I don't spend any of my HSA. I'll keep healthcare receipts. So if I just want some money, I can just redeem it through the receipts.
That's right.
But as far as I'm aware, there's no statutory limit on when you spent it and when you're pulling the funds out,
Yeah.
as long as it's only counted once. So just
Yeah.
make sure you're really good at your accounting if you do
Yeah.
that. But
Yes.
that's HSAs are they're really nice in that maybe that's your long-term care plan.
Mm-hmm.
But that's one of those 50 years old to 65 or whenever you end up retiring, put funds in there,
Yeah.
grow.
All right.
What else do we miss?
Gosh. Did we? I mean, we're so good. We covered everything, right?
Yeah.
We left no stone unturned.
We solved it.
We're just solving things left and right here. Yeah, I think at least for
Let me do one
Yeah.
caveat. Just this isn't healthcare. This
Okay.
is taxes.
Oh yeah.
If you have a healthcare cost that's extensive and all of your money is in an IRA, you're getting hit twice. Because if there's like $100,000 medical bill on top
Oh.
of your already existing expenses,
Right.
you're paying income tax on that.
So if you have to pay for some huge medical expense and you take it out of your IRA, ordinary income.
That could, I mean, long-term care costs,
Uh.
healthcare costs, if all of your money's in an IRA, could be pretty expensive because it could push you into higher tax brackets. You don't get everything dollar for dollar.
Right.
There are things to be aware of. Tax code can change. I mean, wouldn't that be nice if they say, hey, your IRA, if there's a healthcare cost, it's tax-free.
Oh,
That'd be nice.
that's bipartisan. Like, who couldn't get behind that?
Everything's partisan today.
Ugh.
you could say broccoli's good for you and someone's going to disagree. No, the pesticides, I don't know, whatever. But
right, sure.
But no, I mean, tax laws are going to change. Be wary of that. But just know that you need to know where your money is, and if there's a healthcare cost, where do you pull it from, and are there other consequences that would follow? Because if you had a high ordinary income that year, that also might increase your modified adjusted gross income, which might then affect your Medicare premiums.
Right.
And then you've got IRMA to deal with. And so not only are you just paying for all these horrible expenses, but then your other costs are increasing as well. So that's why when we say like, healthcare planning is important, healthcare planning has to be done with tax planning. And tax planning has to be done with healthcare planning. And those two need to be done with income planning and portfolio construction. And it all just is one big happy family of
It's like this web, and there's domino
to plan.
effects, and it's all related.
multi-dimensional chess.
We get deep here.
Yeah. Anyway, that's all the time we've got for this show. If you enjoyed it, tell a friend, leave a rating, subscribe to us wherever you get a podcast or on YouTube. As always, go to retireontime.com for resources to buy the book and so much more, or join me live for one of my workshops where I actually build a plan live and take your questions along the way. Thank you so much. We'll see you in the next episode.